Economics and Finance for Engineering Projects, Assignment 3, Project Presentation.
The engineering project that we are discussing is Horsens Iron Limited mining project. It's an iron ore extraction project in Broken Hill, New South Wales. Their plan is to have a port in Mipany Port, which is approximately 390 kilometers away, and they will begin selling in the current financial year and have been mobilizing in the last 2 years since 2020. Company's financial status: debt ratio is 0.01396. It can be set as 13.96%, and this is because the low debt the company has taken on and the heavy investment they've taken on. Current ratio is 0.3331, and this represents that the company's assets are 1/3 of the company's liabilities. Return on equity is 0. Total asset turnover 2021 to 2022 is negative 0.3241. These two values can actually be explained due to the fact that the company has made no money as of yet. They're still in the mobilization stage and actually haven't sold any iron to any buyers. So they made no money within the year, and the total asset turnover would be negative due to the external investment. Price to earnings ratio is negative 18.3051, and that is due to the stock price decreasing throughout the financial year. Alternatives of the project. Alternative A is the original proposal, which is to extract iron ore, mix it in with water, and transport it as a slurry via a pipeline. This is over a 10-year lifetime, and it's very cheap to mobilize the site. The major expenses will actually be the port, and the pipeline won't be as expensive. So transportation is a highly limited issue in this alternative. Alternative B is the iron ore to be transported via a freight train, and the freight line retains its value by the end of the project, and it also can be recommissioned after the project, so it's more sustainable. The presentation will cover the alternatives and their viability.
The areas of costs will be operations, which accounts for plant, people, equipment, maintenance, and payments to suppliers. Investing activities, which are for purchasing equipment for the project. Capital investment, which is the slurry pipeline for the alternative A, and railway system for alternative B. Operations will start in year 2 and will continue to increase as the project's production rate increases over time. This increase will result in higher operations costs, which we estimate to be around $1 million per 4 million tons increase, without taking into account the 7% inflation rate. For investing activities, we will invest every 10 years to help maintain operations of machines and increase production. There will be no debt as the company relies on their cash reserves and $200 million equity facility. For capital investment, it will be just the one at the start of the year for the slurry pipeline, which will be $12.4 million, and the railway system for alternative B, which is around $3.36 billion. The benefits of the project will be the sales revenue that is expected to commence in 2024, which is year 2. To calculate the potential revenue of the iron production, it will be in assumption 5. It will be using the 70% Fe iron from North China at $177.19 per ton. This is calculated by the 1% Fe differential that provides $2.16 per 1%. And we have a 5% greater than their iron, which leads us to $10.80, and a $7.5 premium, which leads us to $18.30, plus the $158.89, which is the standard price, and it will lead us to $177 there. Upon commencement of selling, it will be 60% of full capacity due to the delays in the project, as they would be in the establishing stage, and is a new product in the market, so they would not be able to sell all their products. We also expect this to increase by 20% each year until full estimated production, and will exceed this production to maximize profits due to greater demands. Alternative A will also have greater amounts of revenue due to the transportation method of the slurry pipeline that can accommodate greater production rates.
Hi, my name is Hansuj Karunaratne. Now I'm going to show the cash flow statements of both alternative A and alternative B. Initially, in alternative A, we estimate that the company has invested $7.4 million in the beginning, and multiple times they have invested the amount because this is a mining project. So in the alternative B also, initially they have They have invested $3.385 billion. It is more than the alternatives A's initial price, and they have invested in multiple times during the project. At the end of both alternatives, the company has invested amount because for the clearance and environmental works. When you go to the revenue section, they are getting the revenue from year 2 onwards in both alternatives. And when you go to the operating and manufacturing cost, in each year the operating cost and manufacturing cost is increasing. So the most important thing is the company is financially strong, therefore they don't go for any financial activities. So in both cash flows, we have calculated the net cash flow. You can see it in here, and we put the inflation rate and calculate the constant net cash flow in here. Let's go to the viability indicators. Throughout the project, we have calculated 4 viability indicators. Those are net present value, dynamic payback period, internal rate of return, and benefits to cost ratio. First, we look at the viability indicators value. When we get the NPV, alternative A get $48 billion, alternative B get approximately $21 billion. So NPV rate of alternative A is higher than alternative B. When you go to the payback period, alternative A get the initial cost from 2.28 years, but alternative B achieve that point in 5.46 years. So when we go to the internal rate of return, alternative A got 594% of that, while alternative B get 34% of that. So when we got the benefits to cost ratio, BCR get 1.59 and alternative B get 1.20. Like if we get a summary for both alternatives, we can see the revenue beats the estimates cost in both cases, but in alternative A it's higher, so it is more profitable. When you go to the payback period, alternative A get the less years, therefore it has low risk and more viable. So when you talk about the internal rate of return, IRR get 594% in alternative A. Therefore the project is more viable. In the BCR is as well, the alternative A is higher, therefore benefits will outweigh the cost in alternative A. So we are going with the alternative A for this project.
A risk analysis has been conducted on our chosen alternative, being alternative A. As you can see in the slide, the risks with the highest calculated severity on the project have to do with an impact on the operations and therefore the revenue of the project. So this includes damage and also a cease of operations. Another key risk that has been identified is the difficulties of construction of the slurry pipeline due to a rocky terrain, because the path that has been identified is quite rocky and mountainous. It would be preferable for the project to employ proper scouting of the terrain to make sure that the ideal path has been selected, and to potentially have a backup of equipment in the case of damage. A quantitative risk analysis has been conducted on the values that have been identified with having impacts on the NPV value associated with the project. These values include the inflation rate, the depreciation value, the investment in working capital, the taxable income, and also the income tax values. As you can see, the quantitative risks that had the highest impact on the project are the inflation rate. Other values do not have as much of an impact and are very, very similar values. So this would mean that it would be ideal for the project to keep in mind the effects of inflation rate on the NPV and to adjust their other values according to an increase or a decrease. This would be increasing attempt taxable income, or changing the investment in capital, or changing the value of their revenue. So maybe increasing the value of their slurry pipeline.
Recommendations. Alternative A is actually more viable as there is a drastic difference between the two alternatives, and alternative B is much more expensive. Alternative A is much cheaper to mobilize the site. So the general strengths of the project is there's no borrowed funds and it's an extremely large market. So the mining industry, iron industry, metal industry is actually worth trillions of dollars. So it's a very viable project to undertake. And the reputation of the company is really strong as they already sell strong products and a very high quality iron ore extracted from the sea. Further analysis can be to study existing and emerging competitors, which is what we lacked throughout this presentation and throughout this study. Investment required within the project lifetime is not mentioned, so we don't actually look at the investment we can put in maybe 3 years down the track or 5 years down the track, and the changing of iron ore market price within the project lifetime, which will be around 10 years, it has to really be examined further, probably. Thank you for listening, and I hope you enjoyed.